Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 16. As always, joined by the three amigos. We've got Rich Diaz, the Tom Brady, RIP of Macro, with Acorn Macro Consulting. And then we've got the grandfather in his Patagucci jacket, Keith Dicker with IceCap Asset Management. Welcome back to the show, gentlemen. And as always, to all our loyal audience, our faithful Loonie Hour listeners, again, all we ask, in return for this, all we ask is that you share this episode with at least one friend, one person. Just share the link to the audio podcast here. We are trying to continue to grow the community here, so we do appreciate your support. But without further ado, let's jump into this week's pod because we've got a very busy week. I've never seen so many people upset and disgruntled online over the Bank of Canada's commitment or decision to hold rates at 0.25%. So it was widely anticipated that the Bank of Canada, everybody was like, yeah, rates are going up. And the Bank of Canada held rates. They certainly did a lot of forward guidance that basically March coming up here is going to be a shoo-in for a 25 basis point rate hike. But just tons of people upset. I mean, I've got, ironically enough, we've kind of lambasted the Scotiabank, forecast for 8 rate hikes this year or whatever it was. I was reading his note post rate hike. Very, very upset. So I've never seen like a big bank economist come out and write like a scathing piece. So kind of curious, first and foremost, Rich, I know you talked about testicular fortitude in the last episode. So I'd love for you to elaborate on that post non-rate hike, I should say.
I'll just start out by saying I was quite disappointed. I think it was a Pyrrhic victory. I think that everyone, was expecting it. It was obviously priced into the market. And at the end of the day, I think they were cowards, as I said, on my tweet. I explained my perspective on it. The way I describe it is, to me, it's clear that inflation is absolutely out of control. It's clear that there is a housing bubble that needs to be definitely stopped, but at the minimum, how about this, slightly blunted. And I think it's really important to remember that we're not talking about 5% rate hike here. We're talking about 25 measly basis points. And for some of us who don't know basis points, that's 0.25%, which would have raised it to 50 and really, I think, would have changed individuals' expectation. Now, we understand if you read from the statement and you heard the speech, obviously now the expectations for March, I think if it wasn't a guarantee for, yesterday or a couple of days ago, then it's more than a guarantee for March or whatever the next meeting is. But yeah, I just say I'm disappointed. I mean, it's called a hollow victory, I think, for me. Keith?
Well, I think I need to start with, I don't have a Twinkie. I tried really hard to find the Twinkie. So we're going with these guys instead. That was the bet, wasn't it? Was it to eat a Twinkie?
Sure.
Or was it a donaire? I'm confused.
No, you can eat a wagon wheel. It's probably worse for you.
Let's try. Let's get this thing.
Oh no.
There we go. Here's the wagon wheel.
Oh man, someone's just
can't even open it.
So for those listening on Spotify, Keith is unwrapping this plastic.
Here it comes.
Just all over the mic. This is full.
This is good stuff.
You just lost a couple of years out of your life, Keith.
Okay.
I love it. No, look at this guy. He's sucking back this wagon wheel.
This is a
full grown
I know.
man. Anyways,
What are those that what the Lannisters say? They always pay their debt.
Yeah, they always pay the debt.
Yeah,
That's
yeah.
right.
I sure hope I don't have to eat another wagon wheel again. That's however,
I'll eat one
his
too. I'll eat one
cholesterol's
too.
way
We'll do
up.
it together.
it's kind of interesting. Back in the 50s, when I was a kid, we used to eat
Oh,
8 or
God.
9 of those, before we used to go to the sock hop, on Saturday nights.
Smoke cigarettes inside. Oh yeah.
Yeah. But guys, I don't think Rich did it justice just describing, though, and same with Steve as well, that non-policy move yesterday by the Bank of Canada. So it's two parts with it. From a quantitative financial perspective, markets were absolutely 1% expecting a rate hike yesterday. All the smart money out in the world, they were positioned for a rate hike. And the moment it didn't happen, they all said, holy smokes. Everyone started scrambling, trying to cover it. So last week, I mentioned, you might remember, I mentioned the Canadian Bankers Acceptance Contract. And the way that works, that was priced, for a rate hike. And the moment it didn't, that thing just moved dramatically. So, one of the best trades I've ever been involved with was a couple of years ago when we anticipated that, the bank, they would be taking action, nobody else did. And you make so much money on those things if you get it right. So but nobody was trading that yesterday in anticipation of the bank not moving. So again, just to demonstrate how big it was. So most people are looking at currency markets or even, what's happening with the yield curve and stuff like that. But the BAX contract, that was the big one yesterday, everybody. And Rich, when you come on this opportunity again and you have better data as opposed to a hunch that they're not going to do it, go trade this thing and you'll make enough to, stop doing the Loonie Hour for a long time.
I would never stop doing Loonie Hour.
You'll never stop doing the Loonie Hour. But then you have the qualitative part of it. And as Steve mentioned, every media outlet that's involved with Canadiana yesterday, they were in shock yesterday as well. And even in the presser, I watched the pressers. I'm sure everybody else did as well. And, you shouldn't feel good or bad for anybody. We are, humans and everything, but I just felt bad for those guys yesterday. You can just tell that, boy, maybe if he can go back in time, they would have hiked rates, but it was not a very impressive day for the Bank of Canada. And Steve, I think you might share with us was it Scotiabank that you saw the comments from? Just to give everyone an idea. Now, it's one thing for us on the Loonie Hour to say, hey, we think they should do this or that. But when, one of the big 6 banks, when it was the Dairy Cult comment that you have, I think.
Yeah. So Scotiabank's chief economist basically wrote like a piece which was sent over to me. And keep in mind, like Scotiabank, I think had the most aggressive forecast for calling for basically 7 rate hikes by the end of this year. And so they're basically their piece to let off, like the title of the sort of email says, the BOC pulls a chicken hawk move. And this guy basically just kind of went on and lambasted the, Tiff Macklem and co. Basically saying, what the hell are you doing? And I've read a lot of, pieces put out by big bank economists, and I haven't quite seen one that was worded with that kind of undertone. Like you could see, like this guy was frustrated. I mean, I think it makes his call look pretty bad, right? If you're calling for 7 rate hikes, everybody's shooing in a January move, and then you come out and you don't pull through. Like, I think for Scotiabank now to be like, right. I mean, there has to be a 25 basis point move now at every single meeting for the rest of the year.
It's not happening. That's not happening.
Yeah, it's not happening. I mean, we've already joked about that in the show. Like they're not getting 7 hikes in this year to begin with. But yeah, I mean, I think like, we talked about it on the show too, right? Like, yeah, we, Rich and I and Keith here, we kind of joked about, hey, let's have a fun bet here. And, let's see when, Rich and I were kind of like, I don't think they're going to move just for, let's play devil's advocate here. But like, realistically, like I've talked about it in the show as well. Like I sell real estate. Like I think these guys should have raised rates. Like, I actually think it's better for the real estate market and the overall society and the economy that they should have raised rates. Because right now, again, we've talked about the housing market a few times, but like, go talk to industry experts in that space. Well, I can tell you in Vancouver, like in the past 4 weeks, prices are up minimum 5%. I mean, if you continue on at that pace, you guys can run the math and figure out where house prices will be 12 months from now. Same thing we're hearing in the GTA. Like, it's going through like escape velocity right now over the past 4 or 5 weeks. And so in my opinion, it's like, yeah, why delay it another 6 weeks? Like, just get it over with. It's 25 basis points. So
it's also priced in. I think that's the kind of the joke of it, is that you would have surprised. I don't really understand their mentality. Like, this to me is the mystifying thing. Like, yeah, okay, I was right. Haha, great. But really what I spent the last 2 days trying to think about is I'm trying to get in this guy's shoes and really try to understand what positive could have possibly have been gained from this. Like, the market had priced it in. Every bank in Canada, which yes, they're regulators. Yes, it's he's a technocrat, but let's be honest, the banking sector, they're partners, right? In this economy, they had priced it in. No one would have said, oh, that's a bad move. It was the easiest layup ever as far as a policy decision. And, I find it mystifying. I mean, there was some comments that I read, it was good that they didn't go early because we're still not sure about the Omicron fallout. And we'll touch on that later. I think that's just absolute gobbledygook. But the other thing that I think is really interesting, maybe a month ago, we talked about, it's not just enough for the central bank to be independent. It has to appear independent. That was my big beef with having the finance minister, abreast to Tiff Macklem when they did their, when they rejigged the policy mandate. But I think what's also, he's broken sort of another cardinal rule, I think, of being an unelected technocrat, is that he's now getting the ire of Joe Public, of, Joe Everyman. The fact that the Bank of Canada was trending on Twitter in Canada, to me is I think a shocking indictment of his job as the central banker. No one is really supposed to know this guy's name, and you're supposed to basically just be this background figure. And so it's all over the shop, whether it's just the fact that it was easy, whether it's the independence thing, whether it's a clear housing bubble. I mean, there's a bunch of reasons why, and it's just cowardice all around.
I've got a quick comment. So, and I'm curious to hear your guys' opinions. Okay, so first and foremost, if I'm going to give any sort of credibility to the other side of this argument, they were very, very adamant in their last meeting, and reporters asked them several times. They were very adamant that they didn't see a rate increase or liftoff until their quote, not mine, quote, the second quarters of 2022, which you guys can again figure that out what that means. So when I watched his speech there for 45 minutes, whatever it was clear that he was trying to say, listen, I'm going to try to be as very straightforward, and this is exactly the path that we're going to go. And so I think he was just kind of following up to that. But again, they probably should have pivoted course and just got it over with. Now, what I'm kind of curious to hear is, because I just think I think people are kind of figuring out central banking, federal governments, they're all political entities. I think this is all kabuki theater, these central bankers. Do you not think, though, when you look at Canada's horrendous debt picture, I mean, even the rest of the global economy is obviously super levered. You're kind of at this end of this Keynesian debt super cycle. When you've got so much debt, isn't it good to have inflation running hot? Isn't this really what they want? They come out and say we're gonna fight inflation, we're gonna be really tough and beat up inflation, and don't worry, we got this under control. But if you've got debt to GDP in Canada at 360%, isn't it good to have inflation running higher than your rate of interest to slowly basically evaporate the worth of that debt. Like it's like like Rich, you've talked about, like it's like a soft default. Like,
yes,
isn't this what they
the answer
want?
is yes. The answer is, I mean, you've been reading my notes that I've been sending to you. So thank you for that. I mean, yeah, I'm not going to go on and on. Keith, let's say there's Keith's view. You guys know, my view on this is quite clear. The answer, Steve, is yes.
The answer is yes. However, for it to work, guys, the fiscal side of the equation has to run surpluses as well. So as long as they continue to run deficits, which means they continue to borrow increasingly amount of debt year after year after year, like this whole, it's a fairy tale. We're going to inflate our debt away. It doesn't work if you continue to issue more debt and more debt. So that's the problem that we have here. And me, I'm skeptical about a lot of things. And I've said it before, and I'll continue to say it. The world is not this nice, neat, shiny little box where everybody has the best or the heart intentions to doing things. The Bank of Canada yesterday, they would have got the nod. So the Fed would have called them and say, hey, this is what you're doing today. Anything else, don't even talk about it. Get the back of the line here and, play ball. That's the way it's going to work. And people can agree or disagree with it, but remember that the Fed, they control what's happening here, the story. Gene, with the Fed yesterday, because we got to talk about the Fed, because the Fed, we're Canadian, we're talking about the Bank of Canada, and, the world is not, revolve around Canada, everyone. Not even close. Shocking. I know it's not even close, but yesterday afternoon, it was just a coincidence that the U.S. Federal Reserve, they came out with their central bank policy announcement as well. And theirs was right in line with what expectations were. That's what central banks do. Policymakers, you have an idea, you float it out there a few times in the U.S., and they float it out through Wall Street, get the market reaction, it comes back in, then they'll soften it or harden it a little bit on the edges. And next thing you know, everyone is in line with what's going to happen. And that's exactly what happened in the U.S. yesterday. And they're absolutely going to continue. They're going to become hawkish. They're going to cut back on QE. They're going to try to, wind it down if they can. And they're going to start raising rates. Because also remember last week, the Chinese came out and said, hey, don't raise rates. If you raise rates, it's going to screw us over. So now here we are now the day after. And the US dollar, which is called King Dollar around the world, if you're aware of that or not, King Dollar is just whacking everyone here today, and especially with the Russians as well. Actually, ruble is up today, but that's for a different story. But again, with the Americans raising rates and the Canadians will raise rates at the same pace as the Americans, this is playing out exactly as the way that we're expecting it to. And then Steve, you mentioned that, hey, there's no way Canadians will get 7 rate hikes in. We are clearly on the path towards some kind of I like to use the phrase, we're going to see a re-escalation of stress in a financial market, which is another way of saying, hey, like we'll get to some crisis of some sort or another coming along here. And that's exactly where we're headed. So, we can be excited about the non-announcement or excited about the upcoming announcement, what's happening. We're looking at the trees, that's it, and the branches. The bigger picture is the world's going to get tighter, and we need to prepare for that accident that's coming out here, which will affect Canada. Maybe the Canadian housing market is the accident. Again, I always think it's going to be coming from outside of Canada, but the Bank of Canada just gave everyone a green light for 6 weeks to pile on some more. Now, Steve, I don't know if anyone is buying a house as a 6-week investment. It's not something I would suggest, but I can tell you people are, no one changed their mind this morning to not buy a house. If I'm selling my house, I'm lining it up right away to get it out.
I mean, yeah, I think we talked about this like on the last show, but like I said, it's basically, you have to understand, like people that are watching the show, like, okay, the Loonie Hour isn't quite mainstream. We're not there yet. Most Canadians have no idea what the hell we're talking about. And most Canadians, again, when they hear, oh, interest rates are going up, I mean, I would say 98% of Canadians don't know who Tiff Macklem is. When they hear interest rates are going up, the initial thought process is, okay, my mortgage rate that I have, on hold at the bank for the next 90 days, when that expires and I haven't bought a house, I'm going to have to, I'm going to get locked in at whatever the new going rate is. And if that's, if that goes from, 2.9 to 3.3%, that's going to cost me $200 more per month or whatever. That's how they look at it. So they push their house purchase forward. And so, yeah, I mean, my view still on the housing market is I think it's going to be a really strong, crazy year up until these rate hikes really start to filter through, which is probably more of a Q4 story, in my opinion. So that's why I was saying, right? I mean, if Macklem had moved 25 basis points in January, that starts to filter through into your variable rate mortgage a little bit sooner. So he kind of gave the housing market an additional 6 weeks of life here.
Yeah. So that's the other thing that we always forget. It's also signaling. Their job is not just to raise rates or lower rates. Their job is to signal stuff, is to tell you, is like, that game as a kid, like green light, red light, yellow light, or whatever. And you're running across the gym. I mean, he just gave everybody a green light. And there's one more thing I think we don't talk enough about this on this pod, actually, is we always talk about, the policy about inflation. We talk about the lie that's been told. We talk about the reality that we all feel. We talk about whether or not the policy goal is sustained inflation. I think they're going to get it. And I actually believe that the economic risks to that policy goal are probably moot, But I think, but show me a society that survives the political risks of that inflation. I think it's something that we don't really discuss here. Maybe we can going forward. But I think that this idea that inflation is somehow benign from a political standpoint, I think is a very, very dangerous game to play. At the extreme, you have something that we all are familiar with. It's Holocaust Remembrance Day, or if it's not today, it was yesterday. But, the Weimar Republic was the extreme of what happens when you let inflation go absolutely bananas and you make no attempt to rectify that through all kinds of silliness, whether it's your fault or not, it's irrelevant. That the reality is they did not do anything to affect that. And I think that the political risks of inflation, I think you're going to start feeling them more and more. I think that's, people are going to start blaming other people, and there's going to be winners and losers, who owns houses and who doesn't own houses, who owns stocks and who doesn't own stocks. The exacerbation of the inequality wealth terms is going to leak into our political discourse. And I think that that's a really dangerous game. And so, yeah, I just think it's something we should just sort of pin, maybe not for today, but we should definitely keep in the back of our minds as we go forward.
Just to with the Weimar Republic. So everyone, Rich is referring to not really. He's referring to the German government that was controlling Germany in the early 1900s, so pre-World War I. Is that right?
Yeah. Yeah. Anyway,
post World War I.
Yeah, around that time. And but one thing that people, they always think, oh, inflation went through the roof. And they see the photos of the older guy with a wooden wheelbarrow full of cash.
Exactly.
Or you go in for dinner and you order your meal, and by the time you get the check, the price has gone up again. People misinterpret the reason for them having hyperinflation because they printed money. That's not what happened. They had to print money because they were not able to borrow. So foreign investors said, for whatever reason, it was a financial reason, of course, they said, we are not lending to you anymore. And then all of a sudden, the local economies, that they couldn't import stuff, they didn't have enough money for it. The government started printing money all the time. Like what you're hearing now, for example, in some of these other smaller countries. The parallels with that today is that everybody is in this situation that's just before that moment in time. So we Canadians, you have way too much debt. So whereas at the government level, corporate level, household level, there's too much debt there. And this is something that we talk about quite a bit. And I think everyone else as well, but they don't quite appreciate what the next step is. Now, I alluded to this somewhat yesterday on Twitter. I said, hey, this now sets everyone up for like another event here. And what the event is that at the moment you walk into a debt crisis, first of all, interest rates spike higher everywhere because people want to get compensated for taking on more for lending to you. But you also run into this awkward moment when all of a sudden nobody will lend to you. And that's then when you have to start, printing money to try to keep things going in the local economy. And people get quite upset about it, like you just mentioned, Rich. And, it's, the government will turn over and all that stuff. But this is a situation today where everybody has that exact same exposure and liabilities. And so who's the first one? We talk about the gym games. What is it? Duck, duck, goose. Is that another game? You go around and I don't know. I'm terrible with these things.
Red light, green light. I don't
know. But my point is that
okay,
somebody out there is going to be that country or economy that's just simply going to be shut off from borrowing from foreign investors. And it just, kapoof, it goes in the middle of the night. And then there's another one, not far behind it. And that's how contagion starts. Contagion is not linking up a country's economy with, who they're doing trade with and stuff like that. Contagion begins when foreign investors say, I'm getting the heck out of there. And it ends when foreign investors say, okay, I now feel comfortable enough to go back in there. And so with this delay by the Bank of Canada yesterday, it just, it's a stupid analogy, but everyone's, blowing air into this balloon and it's getting bigger and bigger. And he just took one more puff into the balloon and we'll let it go for another little bit. But again, it's not a linear, expansion of the balloon, and everything gets stretched, to the nth degree. How is that for a story?
I think it's important though to put that. I mean, every country essentially is in the same boat, that you've got these sovereign debt bubbles all across the world. And I think Canada, as we know, as we are well aware, is probably one of the worst offenders. I mean, isn't our debt to GDP like akin to like where Greece was pre-crisis? Like
no, it's not at that level, but
again, it could be very high relative to the rest of the large economies in the world. It's one of the highest. We'll share the chart, of course.
Yeah, it's again, it could be Canada. I don't know if you guys are aware of this, but the Italians have had 3 attempts now to elect a president of their country.
Yeah,
they still can't agree on who's going to do it. Of course, we're just ticking the EU technocrats off royally, but there's stress out there everywhere in the world right now. We're following the whole Russia, Ukraine, American weird triangle, and the Europeans are completely upset because they're not included. It's they're not a world power at all. So
we're digressing a little bit, but this is why you don't lock down all your nuclear power plants and import all of your fuel and fossil fuels from Russia. We talked about this several pods ago, but anyways.
But go back how people think the world is clean. I mean, the Canadian response to the Ukraine situation was to have people stand up with signs and take a picture of themselves. The Russians don't care about that.
Can I just make a tiny digression? I think we talked about, there's going to be dislocations because as interest rates go and people sort of pull back on that liquidity and pull back on that debt. I think it's really been exemplified sort of in the equity market performance of since the beginning of the year. It's actually started before that. One of the things that we look at is something called, styles. Some people call them factors. I'm not actually sure what the actual real name is, but between something we call growth style or value. And you can see that a lot of the stocks that have been absolutely hammered are these stocks that are basically a direct result of this balloon being blown up, and all this cheap, free, easy, speculative money basically blew up.
Which like the ARC funds that we've talked about a few times.
Exactly.
Yeah, absolutely.
I would also throw in alternative energy stocks into that. But anyway, so what you've seen over the last little while is that the rotation out of these sort of, speculative kind of growthy, not quite sure if these companies actually do anything names, and value is really, really come into fashion. You know, we talked about this in our end of year podcast last year about one of the things that might just happen. And it's really come hard. Basically, if you're a company with a strong balance sheet, strong margins, and the ability to protect those balance sheets and margins, I think you're done really well. And I think it speaks to basically what Keith's been talking about a lot, which is that liquidity is going away and interest rates are going up, and there's going to be some fallout there.
So, I mean, so market events the last couple of weeks, I think we've talked before, like with us, we're pretty well diversified across, when I say different markets, I don't mean Canadian equities and American equities. I'm talking about different asset classes altogether. And that, it holds you back when markets are taking off, but boy, it provides really good protection. So we've done really well over the last couple of weeks with markets coming back. However, one trade that we're doing now, I'm not going to talk about it because we're still involved with it. When we're finished, we'll share it. But whenever we get markets moving like this, again, you don't need to be frightened by it. Just embrace it. And, every good manager, you have your notepad of trades that you want to do. Because with your portfolio, there's always things that you love in it and things that you hate. If you love everything at the same time in it, you're missing something. You're the, what do they say? If you don't know who the patsy is at the table, it's you.
If you don't know the sucker, if you don't know who the sucker is at the poker table, you're the sucker.
Yeah, absolutely. So, with your portfolio, there's always something you don't like in it, but it's there for a reason, everything. And then you have on your list things that you want to do, you want to buy or add to your portfolio strategy, but you got to wait for them to occur, wait for the opportunity to take place. And that's what's happening right now. So I think it's, the market reaction, it's been pretty good. And, that's where we're moving now over the next few days. What are we going to talk about next, guys? The Americans had a GDP number this morning.
I mean, yeah, Rich, I don't know if you have any comments on that. I mean, I haven't looked too much into the numbers, but.
Yeah, I mean, GDPs are always like really far backwards looking. Backward looking. All the data. Sorry, let me start over. All the data we look at is backward looking. Most of it. There's some models that do a good job predicting, but I don't know. I don't put too much stock in that. The GDP is particularly bad because it's obviously what happened in Q4. So that was the latest number that came out, and it was 6.9% real GDP growth. It's a Q on Q annualized number, and versus, I think that's right. Anyway, so it's versus 5.5, which was expected. So GDP growth was better than expected. Okay, sure. I mean, we just came out of recession, so you can't really take these numbers. Really, you have to take these numbers with a grain of salt. The fluctuations are significant at this stage of a recovery. The thing that I think was the really big takeaway was something called an IPD, and it's a bit technical, but the implicit price deflator, which is basically an alternative measure of inflation. And it basically encapsulates all the different parts of the economy. So the service sector, exports, imports, government spending, gross fixed capital formation. And it basically aggregates the quote unquote inflation from all different parts of the economy, unlike a CPI basket, which is a consumer price index, or the PPI, which is the producer price index. This IPD, aggregates basically everything that's going on in the economy and tells you what the overall sort of inflation rate, and that hit 7%. That's a 40-year high in America. And that's an incredible number. And if you think that that's going down to 2% anytime soon, you're in for some trouble.
This I think it's important to also touch on this because there's been some ongoing discussions online with like US CPI is at 7. How come Canada's only at like 4.8? What's going on? Do we actually have less inflation? Rich, I mean, you're the data guy, but like I always say, like, I mean, a lot of that's probably coming back down to like our data analysis or the quality of the data here in Canada. Like, I think our CPI is certainly much higher than 4.8. I don't know if you have any comments on that. I know there was that StatsCan it was like former StatsCan analyst goes rogue and says like inflation is actually higher. It's not properly measuring the rate of inflation. I don't know if you have any comments because I think it's important to touch on.
Yeah, I just think first of all, it's very hard to calculate CPI for an economy with 40 million people, 300 million people, a billion people, right? What is a consumer basket? How does it change? Which consumer are you trying to identify? How do you account for changes in quality, tastes, substitutes? Okay, so I am very critical of the inflation numbers, but I'm also extremely aware, as I think listeners should be, that it's very difficult to calculate those numbers. However, 5% is not the number. It's way higher.
Well, it's always funny because you think about it, you got like a national basket of like, again, they're doing their best job. Like you just talked about, it's not really easy to measure that, but it's like the rate of inflation for like, a millennial in, downtown Toronto is going to be much different than some old guy living in rural Saskatchewan. Like,
sure.
It's just different baskets.
Listen, it's a tough job. I think the real thing is, it's the big lie is that it's 5%. I mean, I know we shouldn't really rely on anecdotal evidence, and we can just, nip this in the bud after and change subject if we have to, but just like, you shouldn't just ignore what you see with your eyes either. Right. I mean, we understand that meat prices and food is not 5%. Right. I mean, I go to next door, I go to get my chicken shawarma like once a week, probably more than I should. 15 months ago, it was $9.89. And just a couple of days ago, it was $11.34. It's like more than a 15% increase. And I can tell you for a fact that I spoke to the manager of the place and I was like, you've raised it by 15-20%. And the guy's like, yeah, I know. And we're taking a hit on that. He's not passing through all of the inflation they're getting.
I've got
Rich. Wait, I think
that was my first story.
That is an unacceptable view.
Oh,
somebody check the Donair prices here.
I think it's unacceptable to have a view that's not been approved by the official policymakers. So that's, of course, we'll go into that as well. I need, Rich, that was not a bad story. That was pretty good. You're starting from the bottom, so you are getting better. And remember, never let the truth get in the way of a good story. That's what makes them really good and sharp. I do want to comment on the I want to comment on the American GDP number. So it was 6.9. Of that 6.9, 4.9 came from inventories. And so this catches our eye. So this is what's important. What people don't realize, the GDP is the growth of the economy, of course, but it's a very complicated calculation. There's lots of things moving on and stuff like that. When companies build up their inventories, it means they're buying stuff, right? Whatever they're selling, they're buying stuff, and that causes GDP to rise. Inventory contribution to GDP, it's nearly that. It's never that high. This worked out to 70%, 75% of the GDP. So this is not a bullish, roaring economy when you get inventory built. If inventories are being built up by companies because it's being driven by final demand, because Rich is going to buy his chicken dinner 3 days a week now instead of once a week, and that's good, that's healthy. When companies are building their inventories up because they just weren't able to get stuff because of the global shutdown, then that means, hey, this is going to run out of steam somewhat soon. I suspect the inventory bill, I think this will go on for maybe another 2 quarters probably. Like, again, it takes a while to get this thing really running. But the idea of thinking that the American economy is going to be running at like 7% annual growth, for here on out, that ain't going to happen. I remember back in the O's, probably the middle of the O's, like 05 or 06, something like that. Like GDP in the US was around 5%, 5.2. And everyone's like, oh man, this is awesome. This is going to continue forever. And it didn't. Like it does eventually roll over. But that's something that when you're reading any GDP reports about the economy in the US is growing really strong, remember, like look under the hood a little bit. And this one was driven by inventories. So if you understand that, then you'll say, okay, wow, like it is going to come off there. Steve, what do you have there? I know you're itching to say something.
Yeah, it kind of brings me full circle because I was going to ask you guys, like, just listen to this Bank of Canada speech, kind of, again, coming full circle, but they had The Bank of Canada says this is Tiff's words, not mine. The Bank of Canada expects inflation to hover around 5% for the first half of the year before ultimately subsiding and getting down to 3%. The funny thing is, it's like, so he says inflation is going to run at 5% for the first half of this year. And as Keith's saying, it's probably not going to continue and be sustained per se, but then inflation is going to go down to 3% by the end of the year. But then their inflation target is still 2%. So you're still north of your inflation target. So it's like the guy, they're basically still contradicting themselves.
That's an unacceptable view.
Yeah.
Please retract your statement.
Speaking of which, thank you. It brings me to my next point. We were joking about this off air. Did anyone notice that Keith was watching the thing with me? That it was like up until the last question, not one reporter asked any hard questions. Not one reporter asked anything about housing. It was mentioned towards the very end. Tiff Macklem basically dodged the question, and he passed the housing question on to Deputy Governor Rogers there. And she basically said, quote, they asked her about the housing market and the strength and some of the vulnerabilities, whatnot. And she says, overall, the bank's view is that the most important thing that will restore balance to the housing market in Canada is an increase in the supply. Supply has not kept pace with demand, which I look at it and say, you're basically trying to pass the buck. You're taking no responsibility for stoking that demand, because right now you have demand running at these artificial levels because you've goosed interest rates down to zero. I mean, in 2021, national home sales were at all-time record highs, off the charts, like beating any. I think it beat the next highest year by close to 20% in terms of annual home sales. So it's like you goose the demand. Like we've talked about this before, but like if you had mortgage rates not at, let's say, 2% today, but at 4%, I think that you would solve the supply situation very quickly.
That's an unacceptable view. It's not just that, it's immigration too. I mean, come on now. Anyways, go ahead, Keith. Sorry.
Like you say, Guy, it goes back to low rates have enabled everyone to borrow more money. And the low rates have been completely created by the central bank on the short end of the curve, and a lot of things push the long end down as well. However, to not even accept any kind of responsibility of it or to wash their hands, and I asked this hard question before in a closed room meeting with them, and they weren't too pleased with it, so they completely absolved themselves from that question. And like you say, like they were softball questions, guys. Like they were beach balls down the middle. Go ahead, Rich.
I was going to say, show me a sustained negative real interest rate. I'll show you a real estate bubble. It happened in Ireland, Spain. It's happening in Germany in 2014-15. German house prices have doubled over, I don't know, how many years it took, but not long. Canada, it's the same thing. It happened in the US as well. The other thing that low rates do, and I know we're jumping around all over the place, but and I have to share this because it's one of the saddest charts that I've ever seen, is that it siphons money away from what should be money. The money should be, in inverted commas, should be used for productive assets to things like real estate. I guess that's sort of not as productive, but one of the things is like real estate and development spending in Canada is basically at a 20-year low. And it's just these central banks have blood on their hands, I would say, not to put too fine a point on it.
I think you mentioned there, I think it was residential, or it was business investment, right?
Oh yeah. Sorry. Public and private gross fixed capital formation. So in the form of research and development hasn't increased in 20 years in Canada. And you say, why? And it's like, okay, partly it's because of shift away from oil and gas. I mean, there's been a desperate move away from that. I get that's part of it, maybe. But it's also partly because if you've got an extra buck to invest, why not just, plow it into this housing bubble? And it's not good.
Yeah. I mean,
it's not good.
If prices are going up annually 10, 15, 20%, I mean, it's kind of like it is ultimately the best use of your capital.
Yeah, of course.
Right?
No,
Like why, why start a business?
So the other side of this, so the other side of this, this is what I see on our desk all the time. With lower and lower rates in the marketplace, it's, the Bank of Canada and policymakers, they say, well, this is great. It encourages investment, whether they carry through with it or not. That's the private investor's choice or decision. But by doing that, it robs that very low risk passive income for the other side, for the investor. So, the person who was living off a 4, 5, 6% GIC in the past, that could live their lifestyle with whatever they want to do. They're quite able to do that. That doesn't exist anymore. And they're not even able to buy, sovereign debt at, say, 4 or 5%. I mean, it's forcing the most conservative investors in the world, not just Canada, but in the world, to bear all the risk that the policymakers are using to try to stimulate the economy, to keep this debt machine, this debt bubble going. And we call that, we refer to that as you're socializing the bad debt problem. So everyone who's borrowed excessively, way beyond their means, that includes the governments, includes households and companies. The ultimate segment that's sacrificing this are the savers, the most conservative investors in the world. So what they have to do, so people might say, well, they're not doing the borrowing. So whoever's borrowed, they can't pay you back. That's a loss for someone out there. But with these low rates, it's enforcing the most conservative investors to invest in preferred shares. They're investing in junk bonds, or as your bank or an advisor will tell you, it's a high yield bond. That sounds better than junk bonds, but it's still junk. They're buying emerging market debt. Now they're buying equities that just focus on paying dividends. Again, it's really distorted the entire playing field out there. And this is something the Bank of Canada, they will not talk about. I asked him the question before about I asked Carney about socializing the bad debt problem. This was back in, I think it was 2011. I think that's when I had an opportunity to meet him in a group down here. And he said, oh yeah, we're absolutely socializing the bad debt problem around the world, but that's the solution we have. And then I asked one of the Bank of Canada members there, probably 2018, the same question. And he really didn't appreciate the question. He wasn't like, Carney was actually quite nice to me. This other fellow wasn't. But that's what's happening, guys. They're making everyone pay for this low interest rate world, and most people are not aware of it.
I think that's Russell Napier. I don't know if anyone follows him, but I really appreciate his work. He's awesome. He calls it basically the way the system, to kind of put it in simpler terms, he calls them levered geniuses. So he goes, anyone that has gone and taken on all this leverage, bought 3 condos, whatever. He goes, they've looked like geniuses, right? They've taken on massive leverage and asset prices have ripped. And he goes, now what's going to happen is, like, there's no choice whether you're a saver or you're one of the levered geniuses there, that you're going to have to bail out the levered geniuses, because he says the levered geniuses are going to take everybody else down with them. So he's like, when this thing eventually blows and whatever, something happens, it's the levered geniuses that will bring everybody down. And so, yeah, it's to Keith's point, right? It's like you've forced these sort of more prudent savers, these retirees, these pensioners to push out on the risk curve. If you go on the Bank of England's website, it says right there, it says one of the quote intended consequences, not the unintended, one of the intended consequences of QE is to push people out on the risk curve. To, instead of investing in a GIC, they want you to buy, a pre-sale condo. So take that what it is. It is what it is. It probably should piss off a lot of people, but these are the current rules of the game, and it's been the levered geniuses, the unprudent ones, so to speak, that have been ultimately rewarded.
That's an unacceptable view, Stephen.
I think we should. That's a good way to end it there.
Wait, is the end of the show?
Yeah, we're
Well,
about an hour in.
Okay, well, great.
Loonie
Then it's
Hour.
my turn to take to. Then I want to. That I was right about the rate call, my reward is my free plug.
Correct. Well, this was
And,
agreed to prior to, by the way, everybody. So bear with us here.
Bear with us. So yeah, I just want
to.
so I just want to. So Acorn Macro Consulting has a brand new website. So I encourage everyone to go and check it out. There's loads of free content that's updated regularly on Canada, the US. There's some sector stuff that you can check out. I've written some blogs. If you want to catch up on the Loonie Hour, you can find that too. But most of all, more than just the website, I just want to thank the guys at Antimatter Labs, which are like a local company here in Halifax. Just two young guys who are just grinding away instead of investing in real estate. They're trying to build a useful and productive company. And I was really proud to work with them. They're Nick and Brandon. So there's your shout out, Nick and Brandon. If you guys need a website done or some marketing work, I encourage you to go talk to Antimatter Labs. They were wonderful to me, and I'm sure they'll treat you really well too. So there you go. That's my plug.
Oh, and this guy didn't even plug his own work. Acorn Macro Consulting. They do have a retail version. Anyways, I get the pieces. I am a loyal subscriber, so I highly encourage you. Have my endorsement to go check that out. Sign up on Rich's website if you want to give back in any sort of way. And again, as we always say, if you want to give back in any other way, we certainly appreciate at least one share. And just to continue to grow and build the Loonie Hour community, because the larger this community gets, we hope that our unapproved thoughts and comments continue to grow, and hopefully we can have a healthy dialogue across this great nation, because I think we're all good Canadian people, and we're really hoping for the best for this country. And like I said, if this dialogue can help spark some of that conversation, that's the ultimate end goal here. So as always, we appreciate your support. We'll see you next week.